PGIM 한국 대표로 계신 김용덕 대표님께서 PGIM에 대해서 간략하게 소개해 주실 예정이고, 이어서 에이든 시츠의 발표를 듣고 Q&A 순서 진행하도록 하겠습니다. 질의는 저희 사전에 질의한 내용과 웨비나 중에 지금 Q&A를 통해서 실시간으로 질의가 가능하시거든요. 질의를 해주시면 레이든 씨께서 답할 예정입니다. 저희가 통역사도 있기 때문에 한글로 이렇게 자유롭게 해주시면 저희가 영어로 번역해서 레이든 씨께 전달해 드립니다. 오늘 일정은 11시경에 종료될 예정이지만 질의 답변에 따라서 일찍 끝날 수도 있고 아니 조금 늦게 끝날 수도 있고 플렉서블. 마지막으로 레이든의 발표 자료는 세미나 이후에 오늘 프레젠테이션 자료는 홈페이지에 게시할 예정입니다. 그리고 녹화된 영상에 번역된 자막을 입혀서 페이지에 게시할 예정이오니 참조하시면 됩니다. 그럼 오늘 웨비나를 시작하도록 하겠습니다. 저희 이 협회에서는 회원사들과 국내 투자자들을 위해서 매월 글로벌 파트너와 함께 정기적으로 웨비나를 개최하고 있습니다. 시적절한 주제에 대해서 해외 최고 수준의 전문가들의 의견과 직접 들을 수 있는 기회를 마련해 드립니다. 협회에서는 글로벌 파트너인 피짐과 공동으로 개최하는 웨비나는 피짐에서 글로벌 거시경제를 역임하고 있는 에이든 씨께서 뉴욕에서 직접 이렇게 참여해 주시고 있습니다. 4월 말이 바이든 행정 100일이었는데요. 바이든 행정 100일을 돌아보면서 미국 정치 환경의 변화, 바이든노믹스의 순항, 정부 지지 여론의 상승과 정책 기조 속에서 물가, 금리, 환율, 글로벌 자금 흐름이 장기적으로 어떻게 영향을 받을지에 대해서 에이든 씨께서 설명해 주십니다. 그럼 김 대표님 소개 부탁드리겠습니다.
안녕하십니까. PGIM Fixed Income에서 한국 영업 및 고객 관리를 담당하는 김용덕입니다. 먼저 이번 웨비나에 PGIM Fixed Income을 초청해 주신 금융투자협회와 참여해 주신 모든 분께 감사 인사드립니다. PGIM Fixed Income은 미국 프루덴셜 산하 자산운용사인 PGIM의 채권 전문 운용사입니다. 미국 뉴저지 뉴욕에 본사를 두고 있으며 작년 말 기준 미화 9,680억 달러 이상의 투자 자산을 운용 중입니다. 전 세계 900여 기관으로부터 자금을 위탁받아 운용하고 있으며 작년 말 기준 총 996명의 직원이 전 세계 8개 주요 도시에서 근무하고 있습니다. 오늘 웨비나에서는 PGIM Fixed Income의 수석 이코노미스트이자 글로벌 거시경제 리서치 대표인 네이든 시스 대표께서 주제 발표를 해주실 예정입니다. 네이든 시스 대표의 양력을 간단히 말씀드리면 2017년에 PGIM Fixed Income에 입사하였고 입사 전 미국 재무부 국제업무 국장을 역임하면서 국제경제정책 분야에서 미국 정부를 대표하였습니다. 그 이전에는 씨티그룹에서 국제경제 글로벌 대표, 연방준비제도이사회의 국제금융부 이사, FOMC 이코노미스트, IMF 수석 고문, 패터슨 국제경제학 연구소의 개건 교수 등을 역임하였습니다. 그러면 지금부터 주제 발표를 시작하겠습니다. Nathan, it's over to you.
All right. Well, very good. It's wonderful to be with you today, and I'm very, very honored to have the opportunity to share my views about what's going on in the United States, in the political sphere, and then the implications of that for the macroeconomy in the United States, financial markets, and globally. Let me begin with this brief overview and just make a few key points here. It's kind of the structure of government that we have at present, and also a brief summary of those November elections. But the bottom line on the presidential outcome was, after all the sound and fury that we had in the country, you know, at the end of the day, the election really was not terribly close. That Joe Biden won by 7 million votes, by 4.5 percentage points, and had a comfortable victory in the Electoral College as well. Now, the story for Congress, however, was very different. The Senate is divided 50-50. And this doesn't happen very often, that it's evenly balanced. You know, of course, the Democrats control the Senate because Vice President Kamala Harris can break any ties. But getting anything done requires unanimity amongst those 50 Democrats. You can't have any dissenters. And this is something that I'll talk more about in a moment. That the Democrats have been extraordinarily cohesive and have been able to stay together on a number of issues. Similarly, in the House, the Democrats have a majority, but it's very narrow, and they can only lose a handful of votes and get their policies through. And so kind of the bottom line in my mind is Joe Biden won a comfortable election, but he's governing a Congress that is evenly divided with just a slight favor toward Democrats. And frankly, I think he's governing a nation that's very, very evenly divided. So with that, let's now proceed to the next slide. And I wanted to start with this up top and just underscore that as Biden took office and as he is formulating his policies, that clearly job one for the Biden administration is defeating the virus and getting the vaccination campaign completed. He has other things on his agenda and on his radar screen, but this is job one. And I think the good news for President Biden is it is going pretty well. As you see on the left panel, since he took office, coronavirus cases have fallen sharply, and coronavirus fatalities have fallen sharply. Now, some might say that the seasonal patterns have been supportive, but they are down very significantly. Further, as you see on the right, the United States is that light blue line. The vaccination campaign has proceeded quite smoothly. We're at a place now where roughly 46%, give or take a little bit, of the population has received at least one dose, and almost 60% of the adult population has received one dose. Now, there are lots of debates as to where herd immunity is and how to think about it. But as we've looked at the international data across countries, kind of our observation has been that once you get to a point where roughly 30% of your population has received a dose, that you start seeing the case counts and the fatalities come down. And the United States is now substantially above those kinds of breakpoints. So I am relatively optimistic that we'll continue to get good news in terms of cases and fatalities. Are there some concerns? Absolutely. We'd like to see 70+% of the total population vaccinated, and we still have a ways to go to achieve that. I would say one major barrier is only one of the vaccines is approved for younger people. Pfizer was just today approved for 12-year-olds down to age 12. We don't have anything for younger children, and it's the only vaccine for 12 to 18-year-olds. So we're kind of limited in terms of vaccinating youth still. And then a second challenge we face is that there is a fraction of the population, and I think it's probably around 15%, that just don't want to be vaccinated. They're skeptical about the vaccine, worried about it for some reason, and just don't want it. So it's going to be a struggle given these challenges to get up to 70% of the population, which is where we'd really like to be. But we are moving in the right direction, and the progress is significant. And as I'll talk, this has been probably the major achievement of the Biden administration so far. Now, let's proceed to the next slide. Let me talk for a moment about some of President Biden's key appointments. And my sense is that personnel is policy, and through the personalities and perspectives of the individuals that President Biden has appointed, I think we learn more about him and his priorities. And I was also honored to have the opportunity to work with essentially all of these folks in one way or another when I was in the Obama administration. Janet Yellen, of course, is the Secretary of the Treasury. I would say that Janet Yellen gives the administration instant and significant credibility in terms of its economic policies. When Janet Yellen advocates for some action, others may agree, they may disagree. Larry Summers has debated the administration a little bit, but people have to say that Janet Yellen is a solid economist, and if she gives her reasons for supporting policies, people have to admit she's somebody who thinks things through and makes decisions based on solid reasoning and good judgment. So I think that she's given them significantly more credibility in defending and articulating their policies than they would have had otherwise. A second key point about Janet Yellen is that she was a labor economist before she was a policymaker. And she is very focused on getting the labor market back to normal. In the United States, we're still down 8 million jobs relative to pre-pandemic. And I think that if we were to ask Janet Yellen, why in the world are you advocating all of this powerful, substantial, enormous fiscal stimulus? She would say, we've got to do it to get those jobs back. If we wait long, people's skills deteriorate, they'll separate themselves from the labor market. The way to get them back is for the economy to be very strong. And I think that the labor market is very front and center in her thinking and is the key driver of some of the fiscal policies that I'll talk more about it in a moment. Let me also say a word about her policy on the dollar. So Janet Yellen has backed away from the US policy, the quote unquote strong dollar policy. When she was asked about the dollar, she didn't say that. Now, she said much of the other language that secretaries of the Treasury used to say. She said that a market determined dollar is in US interests. We expect other countries to play by the rules and to not manipulate their currency. They shouldn't target them for competitive gain and so on and so forth. But she did back away from the strong dollar. And I think part of that reflects political reality, that some of President Biden's key constituencies, like labor, are not so enthusiastic about a strong dollar. Now, do I think that means that this administration will go out and actively seek a weaker dollar? No. But I think they're going to be a little more subtle in their currency policy than, say, previous presidential administrations before President Trump. Now, I have the Fed up there. I think Jay Powell has been very pleased to have an administration that is providing vigorous fiscal stimulus to the economy. His feeling is that the economy has been too weak for too long, and as a result of that, U.S. inflation has been below the Fed's 2% inflation objective. In response, the Fed has put forward this average inflation targeting framework where they want 2% inflation on average over time, as opposed to just 2%, which some people have kind of interpreted as a ceiling. Further, I think that Jay Powell realizes, in addition to him welcoming the fiscal, he realizes that his term as Fed chair expires in February of next year. So in some sense, Jay Powell through 2021 is running for reappointment and trying to preserve himself in the good graces of President Biden and the administration. Now, my feeling is there is a reasonable chance that Jay Powell gets reappointed, but I would put that probability at about 30%. And I would give probably a 40% probability that instead Lael Brainerd, who you see there on the right, next to Jay Powell, is appointed as the next Federal Reserve Chair. I think that Lael Brainerd is to President Biden what Jay Powell was to Donald Trump, an opportunity for the president to say, I've put in my own person, but I'm also ensuring continuity at the Federal Reserve. But bottom line here is whoever is nominated, we can be confident that the Biden Fed is going to want to keep US monetary policy stimulative, and that the new central bankers are going to be at least as dovish, maybe more dovish than the folks that are currently serving at the Federal Reserve. It's also very likely that the new Fed chair will be somebody that we're familiar with, and we know where they stand on the issues, and there's not a whole lot of uncertainty about their positions. Now, with that, let me just very briefly talk about these pictures on the right. Of course, Tony Blinken is the Secretary of State. And let me just say briefly, I think the Biden administration has found foreign policy to be its toughest nut to crack, the biggest challenge for them. On the one hand, they don't want to pursue Trump's policies. They want to do things differently than Trump. They feel they were elected to make meaningful changes pretty much across the board on what Trump was doing. But on the other hand, they also realize that the world has changed sufficiently that they can't just roll back the playbook to 2016 and do what they were doing in the Obama administration. And they genuinely then have to carve out a third way for US foreign policy that's neither Trump nor Obama. And this is proving to be a very tall order for them and is requiring an enormous amount of work. And frankly, I still don't think that we have a good idea as to where US foreign policy is going to land on a lot of key issues. I think what we know is they're putting greater weight on human rights issues than previous administrations. And secondly, they are very committed to continuing a policy that is tough on China. But what we don't know is what Biden tough looks like versus Trump tough, and what kind of tools they will ultimately use. And I think this is something they're probably trying to figure out, on an ongoing basis. And over the next few months, hopefully we'll be hearing more. Now, as I say that, it's also material that, as far as I know, the Biden administration has not rolled back any of the measures sanctions, tariffs, and so forth, executive orders that President Trump had issued against China. So my feeling is, especially in the economic space, the tech space, the investment space, that President Biden is largely continuing the trajectory that Trump was on. The big difference, of course, is I think if President Trump had been reelected, we would have been hearing threats of more tariffs. And I don't think President Biden is going to escalate tariffs, but I do think he's going to take some further steps to put pressure on China in the years ahead. On the bottom left, let me just say briefly, NEC director, his name is Brian Deese. And the key point I want to make here is that Brian Deese was responsible for the climate portfolio, the environmental portfolio in the Obama administration, and actually worked on climate and sustainability issues in the private sector when Trump was in office. I think Deese's appointment emphasizes just how important this administration views climate issues. And I think it will be very central to economic policy. The US is returning to the Paris Agreement, and I think it will be a core part of the administration's foreign policy as well. And then finally, on the bottom right, SEC Chair Gary Gensler. Key point is Gensler is known as being hard regulator, tough, and I think that we will see tightening of regulation, on the financial sector, probably not so much on the banks, on the big banks, where Tarullo already did the work, but on other parts of the financial sector and the shadow banking sector, perhaps including money market mutual funds, various kinds of ETFs that promise instantaneous liquidity, but trade in relatively illiquid markets, maybe leveraged loan underwriting, and so forth. But Gensler will be active. Let's move now to the next slide. And this kind of brings together my observations in one place about Biden's 100 days. What have been the accomplishments or the wins, what I see as the surprises, and what challenges still remain. So I would say the accomplishments first is that Biden's administration really is running like clockwork. And, you know, the age of government by tweets, the name calling and so forth that characterized the way that Trump did business, he was very unorthodox. You know, all of that is in the rearview mirror. And Biden is running the presidency much more like Obama, George W. Bush, and previous presidents. And I think that this has, you know, reduced uncertainty for markets and investors. With Trump, we never really knew what was going to happen on any given day. I'd always watch my message flow, my news flow, to be extra careful that I wasn't missing a tweet that had huge implications. But Biden does everything on sequence, and it's all carefully calibrated. And I think that has taken down the uncertainty a notch that we all face. Vaccination campaign's been successful. Now, an irony there is that much of that vaccination campaign, and certainly the vaccines, were part of President Trump's Operation Warp Speed. And in some sense, he inherited that. But his administration has executed on that successfully. And the vaccination campaign, as I said earlier, has been a big win. And then third, President Biden was able to push through a massive fiscal stimulus package during his first couple of months in office. $1.9 trillion in stimulus that included meaningful checks to households that really supported the economy during the first quarter. We saw it in the retail sales data in March. provided a lot of support during a period of weakness. Surprises, as I showed you at the top, Democrats have very thin majorities in the Senate and in the House. They have been amazingly cohesive. They have held together. They voted almost unanimously as a bloc. And that's allowed the administration to get things done like the $1.9 trillion fiscal stimulus package. And I think it's going to allow the administration to do some other things that I'll talk about in a moment. Final point I'll say this is a surprise is that Biden's agenda here has been really bold. And I could probably say it's also been very progressive. So there's been a lot of things that Biden has done or has advocated or proposed that have made Bernie Sanders, the super liberal senator from Vermont, that made him very happy. And the way of operating that that President Biden has pursued and his stance on some of these policies is markedly different than the Joe Biden that we saw during this when he was in the Senate, and he was kind of a center-left deal maker. He's just jammed these things through with very little bipartisan support and really very little interest or effort to gain bipartisan support or sign off by congressional Republicans. So those are some of the surprises. A big, bold, progressive, and a unified Democratic Party. Challenges, I'd say immigration policy has been particularly difficult for them. And that's manifesting itself in this migrant crisis on the southern border that's you've no doubt seen in the news. President Biden assigned Kamala Harris responsibility for resolving it. She does not seem very enthusiastic or interested in getting involved. I think it is politically a very challenging issue for her. And I think they kind of have their fingers crossed and are hoping it's going to go away. But this is a really thorny issue that they're dealing with. A second issue that I didn't emphasize earlier when I was talking about foreign policy is I think that the Biden administration was hopeful that as they came to power, that European allies would throw their arms around the Biden administration and say, we're so glad that you're not the Trump administration. Let's work together to confront China and put pressure on China in terms of its economic policies, its openness, its intellectual property policies, its policies on SOEs, and so forth. And in reality, the EU has been very hesitant to confront China. And the administration has not had that leverage that they were expecting and an international coalition to the extent that I think they had hoped. That said, they're pivoting now and are more focused on using the Quad group in Asia, India, Japan, and Australia to confront China. But this is an issue. This is an issue that I'm watching closely. We'll see how it evolves. I've highlighted challenges in foreign policy more broadly. We really don't know where the administration is going to land. We know they'll be tough on China. We don't know what that looks like. Russia, Iran, North Korea. We don't know how they're going to address those challenges. There's just a lot of open issues that they need to get resolved. And then a final challenge, as I mentioned, is, of course, we're still down roughly 8 million jobs. And there's a big hole in the labor market. So with that, let me now turn to U.S. fiscal policy, and then I'll talk a little bit about the economy in the next 20 minutes or so. Let's go to the next slide. Great. So here I just give very brief summaries of some of the fiscal packages and objectives that Biden has put forward. course, as I mentioned, he got a $1.9 trillion stimulus package, a huge stimulus on top of the $900 billion of stimulus that Trump signed off on in December. And it means, a lot of near-term support for spending over the first, second, and into the third quarter. More recently, he's put forward two huge packages. One that's focused broadly on infrastructure, but a very broad definition of infrastructure, and another one that's more of a social spending program. He calls it the American Families Act. Between these two packages, they total a staggering $4 trillion of expenditure. Okay. Now, his proposal, it's money that would be dispersed fairly evenly over 8 to 10 years. So it's not all up front like the stimulus, but still, I mean, these are truly enormous packages, and is some of the largest, most significant legislation that we've seen in the United States, probably since Lyndon Johnson's Great Society in the 1960s. These are just enormous packages. When you look inside, they have some traditional bricks and mortar kind of infrastructure, huge funding to support American manufacturing, efforts to invigorate R&D and subsidize research and development, funding for green investment, particularly including electric vehicles. There's lots of stuff for childcare and a whole host of tax credits. Care, they call it care at home, huge amounts of money for elder care. It really is a broad and eclectic set of proposals that in many ways will have a permanent imprint and legacy on the relationship between the government and individuals and families for perhaps a generation to come. Now, let me also say, President Biden has structured this so that putatively the packages are paid for over 15 years. You know, there's some smoke and mirrors in the numbers, as there often are with these packages. But even so, he's put forward substantial tax hikes that do provide some revenues. He's proposing an increase in the corporate tax rate to 28%. Maybe it doesn't get all the way there at the end of the day, but 25%. Increases in high earners income taxes for household, a marked increase in the capital gains tax, and some other steps. When I put all of this together, my expectation is if he doesn't get $4 trillion, which is the total that he's proposed, he's probably going to get $3 to $3.5 trillion of fresh infrastructure and social spending over the next 8 to 10 years. He's going to get the lion's share of what he's asking for. And I would say similarly with the tax cuts, that the Democrats have been cohesive, and they're likely to remain sufficiently cohesive that he'll be able to get, a meaningful increase in the corporate tax rate. Maybe not all the way, as I said, to 28% to 20, but maybe to 25%. He wanted to double the capital gains tax for high earners from 20% to 40% roughly. Maybe it only goes to 30, but still increases substantially. So we will see some significant tax increases. Now, as I say all of this, the final point I want to make about the fiscal is these packages are being put forward with two separate objectives. One is to make the economy more efficient. And I think the administration is hoping that we'll have a little bit of increase in our trend GDP growth as a result of the infrastructure and the manufacturing and R&D and so forth. But the other core objective for the spending and also for the taxes is to address inequality. The administration feels that distribution of income and wealth is simply unfair, and it's undercutting the legitimacy of the US system. I think they're also hopeful that if they can move $1 from an upper income household to a lower income household, that you're moving it from a low marginal propensity to consume household to a higher marginal propensity to consume one. And that there's likely to be some increases in aggregate demand associated with that. And weak aggregate demand has been a challenge for the United States and many other countries over the last 10 or 12 years. So I think they're even hoping as they address inequality, it increases legitimacy of the system, but may also have some possible economic benefits. But this is big, it's extraordinary. We probably haven't seen anything like it for close to 50 years. And I think he's going to get the lion's share of what he's asking for. Let's now move on to the next slide. Next slide, please. Perfect. I'm going to be fairly brief. As a result of all this fiscal spending, the stimulus and these various packages, the United States is looking at a severe deterioration in its fiscal performance. The budget deficit last year and this year running right around 15% of GDP. My expectation, given what I think Congress is willing to approve, is the deficit will maybe step down to 9% next year, which is lower than 15, but is also a significant negative fiscal impulse we need to think about when we evaluate growth prospects, and remain in that kind of 5.5% range, really for as far as the eye can see. And consistent with that, as you see on the right, US public debt levels are now at 100%, which is the highest we've seen, since the 40s, and are poised to sail upward, approaching 150% of GDP over the next 25 or 30 years. So the fiscal situation is definitely a risk and something that I am concerned about. Now, with that, let me pivot. Let's please go to the next slide, and I will talk some about the macro outlook, and then finish up on what I think it all means for markets. And I've got about 10 minutes, so I'll go through these a little bit more quickly. A key point on this slide is that the US economy is poised for dramatic growth this year. My feeling is we're likely to see about 7% growth in 2021. That reflects this fiscal stimulus that I talked about. It reflects the ongoing vaccination campaign and a normalization. And it also reflects that as a result of the fiscal, coupled with the pandemic, households have accumulated substantial savings. And you see that on the right panel, that right now there's about $2 trillion of excess saving, more saving than would have occurred without the pandemic in the household sector. And we have vigorous debates about how much of this will be spent, say over the next year, versus how much of it will go more permanently onto household balance sheets. It's reasonable to think a third of it will get spent. And, if so, you're talking about $700 billion of additional spending, which is, 3 to 4% of GDP. There's just substantial, almost unprecedented support for demand out there. Now, while I'm on this chart, Let me also say, in parallel with this very strong growth this year, we are seeing, including the CPI report on Wednesday morning, we are seeing a increase in price pressures in the United States. Now, my feeling is that this is very much reflecting two factors. One is that there were some sectors like hotels, restaurants, airlines, and the like, where prices were very depressed because of the pandemic. And now as conditions improve and people are vaccinated, they're able to normalize their prices and bring them back up toward pre-pandemic levels. And as that happens, we're seeing more measured inflation. The second thing that we're seeing, the second driver of this observed inflation, is demand is rising rapidly, and it takes aggregate supply a little bit of time to catch up. The firms have to rehire workers. The firms have to figure out production schedules. The firms may need to reconfigure supply chains. If the structure of demand is different than pre-pandemic, we might need to move some labor from one sector or other resources from one sector to another sector. And kind of putting all that together, it means that aggregate demand is racing ahead of aggregate supply, and we're seeing some shortages and bottlenecks and similar kinds of price pressures emerge in the economy. Now, this is something that I'm watching closely. The price increases we've seen over the last couple of months have been more powerful than what I had expected and more rapid. I kind of thought that the economy would gradually accelerate, would see this kind of in early Q3, say in July and August. It's hitting harder and faster than I expected. But I still think that as the year progresses and we move into 2022, aggregate supply will catch up demand. And then some of this fiscal and some of the other extraordinary factors that are lifting demand will decline. And the supply and demand will be in better balance, and we'll see a significant resolution of these price pressures. And the post-pandemic inflation, as a result of all of this, we'll have some higher inflation this year, but then things will normalize, supply will catch up, demand will soften, and as we move into next year, inflation will come down a bit. But this is a huge question for the markets, and we're watching closely. With this in mind, let's now please turn to the next slide. Here, I show you inflation expectations, and I focus on the 5x5s, which are inflation expectations 5 to 10 years in the future. And what we see is they moved up, and they moved up a little bit more today in response to the CPI, but they're not massively out of line with what we were seeing in 2018 and 19, and still, a little bit below where we were in 2012, 13, and 14 after the global financial crisis. Most of the concern about inflation, understandably, is concern about near-term inflation. But longer-term inflation expectations seem reasonably well anchored. And I think that that gives the Fed some increased confidence and allows them scope to stay stimulative. On the right, I show you the path of core PCE inflation. Those red dots are the Fed's forecasts at the last meeting. Now, if they were writing down forecasts today, given the surprises we've seen, I think that first red dot would be higher than it is. It's their forecast was 2.2. I would guess that they'd have their numbers somewhere above 2.5% for this year. But the important thing is they see these pressures on prices as being temporary and inflation coming back to around 2%. Let's move to the next slide. Given that the Fed expects inflation to come back down, and broadly speaking, price pressures that existed or pricing environment that existed before the pandemic to reassert itself, the Fed is anticipating inflation being soft as we move into 2022, as supply catches up, and as various kinds of structural factors like global competition and automation and innovation and aging demographics all weigh on inflation. And the Fed has said that they expect to remain on hold and to keep rates at zero through the end of 2023. Now, as you see from that yellow line, the markets are not so sure. The markets are actually pricing in a rate hike in 2022 and a few rate hikes in 2023. So we'll see how things play out. But I think the Fed has been, at least until recently, quite comfortable that we will return to a low inflation environment that will require them to remain stimulative to achieve and capture their 2% inflation objective. On the right, a big question in the markets, and we need to listen to the Fed carefully, is when's tapering going to start? I'd say baseline expectation that I show you here is that Jay Powell talks about it in late August at Jackson Hole. Maybe they say a little bit more in November, and then tapering begins in January. It remains to be seen. Do the price pressures we're seeing now cause the Fed to bring that forward a little bit or not? But we're, along with the path of inflation, we're also watching the signals from the Fed on tapering closely. Let's move to the next slide, which then takes these views on inflation and Fed policy. And let me say a word about long-term interest rates. Now, 10-year Treasury yields moved up through the first part of this year, but then just kind of hit a ceiling and have traded around 170 or so pretty consistently over the last, 6 weeks or so. And what's extraordinary is that over the last 3 or 4 days, we've had 2 data releases that have raised concerns about potential price pressures in the economy. And notwithstanding all of that, the 10-year Treasury yield it's moved up a little bit, but only modestly compared to the size of the shocks that we have actually absorbed. And given that, I think that the markets are now in a place where they're watching the Fed. And if the Fed holds its ground and says, we continue to expect inflation to remain low, and we're going to stay, we expect to stay stimulative for several more years, we may be approaching a ceiling for the 10-year Treasury yield. I don't know what shock we're going to get that's indicative of a bigger surprise than the one we got today. And then over the medium term, as inflation falls, as some of these deeper trends that I mentioned, like demographics and so forth, drive low inflation, our expectation is that the 10-year Treasury yield is likely to stay low, probably at levels lower than it's at the moment. But we're not expecting over the medium term significant further increases in the 10-year Treasury yield. In the near term, if the Fed shifts to a somewhat more hawkish tone, I think there's some upside risk. But even then, I think that we're likely to remain in a low inflation environment over the medium term. The right panel just highlights the relationship between working age population growth and inflation. And the key point is that as working age population growth slows, inflation tends to fall as well. So aging demographics, as the United States has, as Korea has, are associated with lower rates of inflation. Now let's go to the next slide, and then which I'll go through relatively quickly, and then I'll answer some of the questions. Perfect. So one of the key questions bringing all of this together is, well, what kind of sectoral or market effects will Biden's policies have? And I think, and our firm thinks, that the major imprint of what he's doing is likely to be felt across industries or sectors. Winning sectors, anything green or renewable, climate policy is going to be enormous, and they're going to invest heavily in that. Infrastructure providers are likely to be winners. Firms trading with China, I think the policy will stay tough, yes, but we're not going to see a further escalation of tariffs like we would have seen if Trump had been elected. So relative to a Trump presidency, firms trading with China will be better off. And as the Biden administration seeks to redistribute income and wealth, lower tier retail, consumer staples, things that households in the bottom half of the income distribution purchase. Losing sectors, oil and other carbon-based energy. It's the flip side of the energy trade. Technology, there's a lot of appetite in Washington to regulate the tech sector, at least to some extent. We may see further extension of government into healthcare space, and defense spending is not a priority for President Biden the way it was for President Trump. And I think varied effects for the financial sector, more potential pressures for money market mutual funds and some of the ETFs and so forth, as I said. So with that, let me now turn to a few of these questions that came in on the chat. First question, at what core inflation levels do you think the Fed will be more concerned and start talking about tapering earlier than expected, and how many months? So I think the Fed, in terms of raising rates, is going to want to see where things land on the other side of this bulge in inflation and aggregate demand. For tapering, it's much more tricky. The Fed has been more opaque. It's been less transparent in describing what it's going to do. I think it will probably absorb some months of 2.5. But if we have several months of 3% inflation, and core PCE is likely right now around 2.8. If it gets up to 3 and stays there for a few months, I think there's going to be a lot of pressure on the Fed to start tapering. So tapering could happen sooner than what I've thought in the past, and the market expectation has been in January. And I do see a little more risk there based on today's inflation data if they are sustained. And as I said a moment ago, that's something to watch very, very closely. Another question regarding your view on weaker dollar and Biden administration's monetary policy. Can you elaborate on what it means to be subtle compared to previous administrations? Yeah, so what I was meaning there is they're not going to overtly, openly say we want a strong dollar, but they're also not going to overtly, openly say we want a weak dollar. They're going to say, we like a market determined dollar, and I think behind the scenes they'll be putting pressure on counterparts to not intervene in the foreign exchange markets and to play by the international protocols of the G20 in particular. So I think it's going to be a little more open and agnostic regarding whether they're happy when things go up and go down than it has been in the past. But I don't think they're going to, be actively pushing, to be clear. I don't think they'll actively push anybody for a weaker dollar. They just won't be as open in espousing a stronger dollar as their predecessors. And then a question, at what level do you think US 10-year will peak in this cycle compared to around 3.2 in the previous cycle? So, you know, I really don't see, unless we're really surprised by inflation, or unless the Fed shifts its reactions and becomes more worried about inflation, it's going to be, I think it's going to take a lot to get the 10-year Treasury yield above the low twos. So maybe you know, over the next 18 months or so, maybe we get up to 2%, but not a lot above it. So I do think that it will be a lower peak in this cycle for the 10-year Treasury yield than in the last cycle. You know, it looks like I've got 1 or 2 more minutes, and I have a couple of questions here. I was asked about the outlook for the US dollar. And let me just say, my sense is that as this year progresses, the US economy is going to be growing very rapidly, but I think we are also going to see a rebound in Europe. Now, the European economy has fallen much more since the pandemic. It's been more adversely affected. So the level of GDP in Europe relative to pre-pandemic is much lower in the United States. Both economies will be bouncing back sharply. But I think that a stronger performance in Europe is going to surprise some market participants. So I think in the second half of the year that there's upside for the euro against the dollar. And I think in that environment, along with a acceleration of vaccinations around the world, I think in that environment we will see some gains in EMFX as well. So I think the dollar kind of moves sideways through the second quarter and then falls off against the euro and some emerging markets during the second half. And on balance, I think is probably somewhat weaker than it is today. I see more downside than upside for the dollar going forward. And I think that that is covers the lion's share of the questions. Either I've spoken to them directly or covered them in the presentation. And it's now 10 o'clock my time, 11 o'clock your time. And I think it's appropriate for me to pass the floor back to Mr. Lee and just say how much I appreciate the opportunity speaking to you and having the opportunity to share my views about what's happening. Thank you so much.
Thank you, Nathan. Thank you. I really appreciate that. Today, Nathan presented really good stuff to the Korean investors, and I hope you all find our session with Nathan to be informative. And if you have a further questions or you need more information, you might want to reach to Mr. Kim, who is based in Hong Kong. And your time, your participation, and your engagement were greatly appreciated. We are looking forward to seeing you again. Thank you.
Thank you.